tucked away on tax day in the consultations and announcements that came out on the 23rd of March was a little line, couple of lines actually, on trust taxation. And we all went, trust taxation? I didn't think that was up for review. In fact, let's remember, it was up for review in 2018. And at last, the government have come back and made a comment on that and said what they're going to do about it. And it's quite reassuring. It said, we received, this was in the statement made on tax day, 23rd of March, we received just over 100 written responses from a variety of stakeholders in response to that 2018 consultation. Responses came primarily from representative bodies, advisors, trustees, and users of trusts, with a smaller proportion being submitted by non-governmental organisations and individuals. And here's the killer. The responses did not indicate a desire for comprehensive reform of trust. No surprises there at this stage. The government will keep the issues raised under review. That's it. So no big change for trust taxation. Well, we weren't expecting any, but it's reassuring to have that, to have a kind of closure on that trust review. And it gives you, financial advisors, a great opportunity, I think, to reach out to your professional connections to just say, it was interesting, wasn't it, that in the announcements made on tax day that finally we were reassured there aren't going to be any changes to trust taxation. By the way, and however you introduce this, it's up to you, but the by the way is, let's not forget how powerful a combination of a trust and a financial product can be in so many ways. That in its simplest way, a trust combined with a life insurance policy will make sure not only that money is paid out at the right times, but also to the right people, free of inheritance tax. Insurance policies that are contributed to by single premium bonds, held in trust, can be tremendously effective for estate planning to either give you control by the use of the trust and very simple investment administration, by the way, or to give you some access via a loan trust or a discounted gift trust, or one of the many variations on the theme that there are these days. So there's also the fact that many trusts exist, and many trusts that exist are run by your professional connections, solicitors and accountants. And for them, an investment bond or the right type of collective may be a very, very appropriate investment. An investment bond in particular, with its non-income producing qualities, is very simple to administer, avoids those high tax rates that are paid by most discretionary, in fact all discretionary trusts, on income arising, on capital gains realised, on interest generated, on dividends received. All of that makes it a bit of a tax minefield, and one of the worst tax positions you can be in for income and gains flow is a trust. You can defer all of that with an investment bond and manage your tax outcome. So the combination of bonds with existing trusts can also work really well. So some really good conversations you can have with professional connections to make them aware, to remind them of the power of the combination of the financial product and the trust, either for new money or for existing trust money. And the combination there that benefits the client is the combination of your expertise in knowing how financial products work and which are most appropriate to be wrapped in a trust, and the solicitor accountant's expertise around having the client and knowing how trusts work. Of course, you will have more than a passing knowledge of how trust works too, which will help build their trust in you. So I think, if you want to know a little bit more about trustee investment, or how those combinations of products and trusts work for new money, for inheritance tax saving, for example, or to wrap a protection plan, just go to Techlink.